The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
All right, let's cut the music. I'm here. Guys, let's do this. I'm Mitch Goldberg. You're listening to Buddy in the Morning with Mitch Goldberg. Thank you so much for joining me. You're listening to 103.9 FM LI News Radio. Couple of things to get into today. First, I usually just go right into the stock futures, but something just caught my eye so hardcore. It just hit me. So I want to open with this. 64% of Americans are living paycheck to paycheck. And this is according to Lending Club report. But it also mentions that there's a record amount of people who make six figures a year who are living paycheck to paycheck. Now, maybe it's because you move into a certain area thinking you could afford it, but inflation has gone up so much, the price of your cars has gone up so much, and you're just trying to listen to your, you're just trying to maintain your standard of living. So you're spending more and more. So I'm looking at some numbers, and the number I want to say is, let's just say hypothetically, and we could make this any number you want, but I just the example came up. I plugged in some numbers, $6,000 credit card balance, okay? The current average credit card interest rate now is 19.99%, so we're going to call it 20%. The minimum payment, 3%, which is $25 a month. It'll take you, with minimum payments, 16 and a half years to pay that off. So starting now, that'll be October of 2039. You'll have paid $7,000 in interest on a $6,000 balance. So that tells you a couple of things. First of all, credit card debt is horrible. It tells you that people who are in credit card debt are not bad people. It's people who are not in good shape to begin with. Reading an article on CNBC this morning, and I first of all, just want to say, I enjoy CNBC. I know the people who work there. I've written many articles for them, and I was just quoted in one of their articles last week. So I'm not knocking it, but I see one article here, and it's one of these articles that is so like a very young person must have been quoted for this, because the advice they give, this, I'm not going to say who it is. It says, well, cut your spending and boost your savings. I mean, when you're giving this advice to somebody who's up to their eyeballs in credit card debt because they don't have money or savings, or they had an unexpected expense or something, you just say, oh, just boost your savings and cut your spending. It's like Mickey Mouse advice. You need a much greater intervention than this. And we'll talk about these things. That's one of the things that this show is about. It's about you taking control of your money, because it's so easy for your money to take control of you. So I don't want anyone suffering, of course, and it's a horrible situation, and anyone who's fallen on tough times gets it. So anyway, let's roll on. Dow futures up 91, S&P futures up 13, NASDAQ futures up 42. So the major benchmarks are up about 0.33% across the board pre-market trading. By the way, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. Oil is off a little. It's been coming down from 82, 83. Now it's 77 and change. The 10-year yield, the U.S. Treasury 10-year yield, which so many rates, including the 30-year mortgage rate, is tied to, is down a drop to 3.49%. And we have a massive amount of earnings that are out. I think some of these are pretty substantial. And, that's what we've been talking about. That's what we started the show yesterday. This is a huge week for investors. It's very exciting. First of all, today starts the Fed meeting. The part of the Federal Reserve banks that meets every 6 weeks to discuss interest rate policy is called the FOMC, the Federal Open Market Committee. They're meeting today and tomorrow, 2-day meeting. Tomorrow around 2 o'clock, we'll find out what they're going to do is in terms of interest rates. And the expectation, broadly expected, is that the Fed raises 0.25%. So 0.25%. And that'll make things like credit cards and short-term interest rate products, variable rate products go up a little bit. We're going to talk about interest rates because not all interest rates are created equal, but I want to get to that at the second half of the show. And let's just take a look at a couple of things. McDonald's dipped a bit more than 1% after its latest quarterly results. The food giant topped earnings and revenue estimates, and customers are increasingly visiting its restaurants. But they do expect short-term inflationary pressures to continue into this for the rest of the year. General Motors, this is the big surprise because auto stocks have been doing so badly that you're just like, they're just going to come out with the worst number. And they shocked. Their revenues were almost $3 billion higher than expected. Earnings, they blew the doors off of earnings expectations. The stock is up 5% pre-market. Ford rose a little in sympathy. Ford was down yesterday. We spoke about that. They cut the price of their Ford Mach-E Mustang, which is a beautiful EV car. But if they cut the price, that means their profit margins go down, so now they have to make it up in volume. That was really being led by Tesla, cutting the prices. Not only did Tesla cut the prices of their cars, but then you get that big discount, the federal tax break for buying an EV. I mean, it's really made Tesla's into an affordable luxury car. The key with Tesla is it more like an iPhone or is it more like a car? Because Tesla has such big margins. And that's the big thing that investors are trying to find out. And I only bring up Tesla because so many people own the stock and follow the stock. And Elon Musk is just such a maddening person to follow. Because one day you're like, the guy is amazing. The next day you're like, what the heck is this guy doing? And, it's just his ephemeral, brilliant mind. He's just an amazing person to follow, whether if you like him or not, okay? But we like everybody here, okay? That's what we're about making you better with your money, not about personality clashes, okay? UPS shares rose a little bit, nice on the earnings. They're doing pretty well in the United States. The rest of the world is slowing down a little bit. ExxonMobil, what do you think of this? ExxonMobil reported a profit for the quarter. For the quarter, $56 billion. Oh my God, $56 billion. And that beat their last record quarter in 2008, which was like $42 billion. So, there's been a lot of politicking around oil. Is it government policies, administration policies, or is it the oil companies gouging the consumer, making all this money, and just, we're down on our luck with inflation and getting out of COVID? I could give you reasons for both. I could back up both arguments because that's what a smart investor does. You look at both arguments. You don't get into a fight about things. You look at both arguments, and then you make your decision after that. But $56 billion, I mean, that is a huge amount of money. Now, they invested for that. Nobody was giving them a break when oil went down to below zero at the heart of the pandemic. So how do you look at it? Private entity, they deserve it? Or is it too much and the rest of the country is suffering? I think for the quarter, the energy industry is expected to generate like $200 billion in profits. Maybe you put a windfall tax on that much money? I don't know. Tough to say. Caterpillar. Shares are off a little bit, but still pretty decent numbers. Below estimates, yes. But they said it was an unfavorable mix. Currency impact. I'm not really particularly worried about Caterpillar. The stock has been up a hell of a lot. So the fact that it has a reason to back off a little bit, fine. That's nothing unheard of. We talk about stocks that are high valuation. So I want to say that Buying or selling a stock based on valuation to me is not that important. What valuation means is if there is bad news, a highly valued stock is susceptible to a bigger drop. And if a stock is a value considered cheap on whatever metrics you use, if they come out with bad news, they don't drop as much. So there's a feeling of safety in a value stock. That's how we judge growth stocks versus value stocks. Okay, so we've got a few more big numbers out, but those are the big ones. And lastly, International Paper, IP is up 5%. They make boxes, deliveries, things like that. So overall, that's the key. Anyway, this is Money in the Morning. I'm Mitch Goldberg with Client First Strategy. That's clientfirststrategy.com. And you are listening to 103.9 LI News Radio. We're going to talk about interest rates and that not all interest rates are created equal. Here we go. We're back. Thank you so much for joining me. I can't believe it's the last day of January of 2023 already. So, the thing about getting older is that just the acceleration of time, it's just like we're going to be done with the first quarter any minute now. And it's like we're going to be celebrating the end of 2023 so soon. And I want us all to have something to celebrate. In March 12th is a special day. It's my favorite day of the year because that's the day we start daylight savings time. Oh, yeah, I love daylight savings time. I just want to make it permanent already. I can't stand it when it's dark out at like 4:30, 5 o'clock. Should never be. You want to get people to stop moving to Florida? I think just make daylight savings time permanent, and maybe that'll make people happier to stay in Long Island, okay? You might call it wishful thinking, but that's what I want. I'm tied to Long Island. I love it here. I grew up here, raised my kids here. My friends are here. My world is here. So I'm stuck here. I'm not going anywhere. I'm not leaving. I'm not leaving. You remember that speech from the movie The Wolf of Wall Street with Leonardo DiCaprio? Saying, I'm not leaving. Okay. So congratulations to all my Long Islanders. I was on the road this morning driving from Melville to MacArthur Airport. I'm at the LI News Radio studio now. There was no traffic. Everybody drove well. There was a little bit of precipitation. Somebody, Sebastiano, said he's grateful for snow. Sebastiano is my producer right in front of me right there. And I'm like, you call this snow? Nah, this isn't snow. This is just like damp stuff. But it's been a really pleasant winter. So couple of things. The IMF, the International Monetary Fund, actually raised its forecast for economic growth for the world based on falling inflation. 86% of the nations are experiencing falling inflation. Household spending continues. And then news out of Europe that the European economy is actually outperforming expectations. It's basically flat, but people expected a horrible recession. We got lucky this year with Europe. It was a warm winter with the shortages of natural gas, the war in Ukraine and Russia's, cutting off natural gas supplies to Europe. Luckily, we skated through this winter in Europe, and they're going to be okay. And the European economy held up pretty good. And China factory activity also outperformed expectations and was pretty strong. So you put these together, and so far decent earnings for the last quarter, but decent forecasts going forward from corporations. The thought of a soft landing is actually starting to become more and more realistic. Hard landing means we go into a recession. Job losses, horrible economy, store closures, lots of bad things. Soft landing is we slow the economy enough to tamp down inflation without actually flipping into a recession. It's kind of a real, to thread that needle for the Fed is really hard to do. And it's so hard to do that it's unexpected, but now it's becoming like a realistic expectation. So we shall see. Obviously, your world, your own personal economy is more important than whether or not we're in a, economic recession or not. So you know what they say? They say when your neighbor loses his or her job, it's a recession. When you lose your job, it's a depression. Have you ever heard that expression before? It's true, okay? I'll give you another expression for all the dads out there. This just popped into my mind because I'm looking at my friend David right over here, who's a great dad. And my father once said to me, in my next life, I want to come back as my own son. I just want to throw it out there so all you dads will have a son who's doing well. Okay. Anyway, and hopefully you do, or daughter. And so let's move on a little bit. Interest rates. Interest rates are not all the same. You have short-term interest rates. You have long-term interest rates. You have variable interest rates. So when you hear the pundits talk about interest rates are up, interest rates are down, it might be totally contrary to what you're seeing with your own eyes. And you might feel like, am I wrong about this? Am I missing something? Am I not sophisticated enough to know what's going on? No. It's not, it wasn't explained. The Federal Reserve, it's like a tongue twister, I say it all the time. The Fed controls interest rates, short-term rates. They could raise the discount rate. That's what it costs banks to borrow money from the Federal Reserve. And they could raise or lower the federal funds rate, which is the cost of one bank borrowing money from another bank. Banks borrow money from each other all the time because every day they're supposed to have minimum capital reserves and they're allowed to use other banks' reserves as their own if another bank has excess, just because of the way their lending books and money going in, money going out works, okay? So the Fed could raise short-term rates, and that impacts credit cards. It impacts the prime rate, which most loans are tied to. But it doesn't really affect long-term rates. Long-term rates are set by people like us, by the market, demand for money. So if nobody wants a mortgage, you might start to see mortgage rates, or if nobody can afford or can get a mortgage or can't buy a house, that means the demand for mortgage money goes down, so mortgage rates would start to go down, okay? You hear about long-term rates on the 10-year Treasury. That's like the main, like you have the S&P 500 as the main benchmark for stocks. The main benchmark for bonds is the rate on the 10-year Treasury, which is like 3.49%. Tied to that are long-term rates like mortgage rates. Investors control that. So even though the Fed could raise interest rates, it doesn't mean long-term rates have to go up too. They could go down because that's a different area. That's a different, it's controlled by a different group. So that's why sometimes you see interest rates going up in one area, but going down in another. Right now, short-term interest rates are really high. It's like 4.7% on a 6-month T-bill, Treasury bill. Okay, when you have a Treasury security, when the government borrows money, it issues bonds called Treasury bonds or Treasury securities. Treasury bonds that are a year in maturity or less, we just call them T-bills. I'm just giving you the vernacular, so when we talk about this, we're all on the same, we're all reading from the same page. So T-bill rates are more sensitive to short-term rates that the Fed controls. So the Fed raises rates, T-bill rates typically go up. But the 10-year yield is only like 3.49. So why is it a full percentage point plus? It's more than a percentage point lower than T-bills. Because as market participants, we don't expect inflation to be a long-term persistent problem, at least as far as what the bond market is telling us. It might not be what you think, but that's what the bond market is telling us. So therefore, we have different kinds of rates and different rates. And when that happens, it's called the inverted yield curve. I talk about this a lot, but I just want to say that when short-term rates are higher than long-term rates, banks in many cases don't make money making loans, which means less credit is available. That slows down the economy, and that could cause a recession. All right? So not all interest rates are created equal. So let's go on, all right? I want to talk to you about your credit cards. We said before, if you pay minimum balance on a credit card balance, it could take you anywhere from 16 to 18 years to pay it off. This is why credit card debt is the worst kind of debt there is. And this is why when you have credit card debt, it is the worst thing for your credit score. An auto loan, not so bad. Mortgage loan, not bad. Of course, if the payments are a big portion of your monthly income, then the credit agencies, well, it could be a problem. The credit agencies just want to go by your ability to pay. But when they see that you are increasing your credit card debt, they start to realize that you could be in trouble also, and your credit rating starts to go down. Something you should know. Okay, anyway, this is Mitch Goldberg. You're listening to Money in the Morning with Mitch Goldberg. Check us out. I have a new website, by the way. It's called moneyinthemorning.info. Check it out, moneyinthemorning.info. I'll be back tomorrow, and thank you so much for joining me. You're listening to 103.9 LI News Radio.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.